13F has actually been one of my best places to find investment ideas. I've been very, very successful finding ideas within 13Fs. One of them that I talked about on the YouTube channel in 2022 is actually TPL, Texas Pacific Lands, and then I bought it around $1,000 per share. I sold it around 1,400 or 1,450, so I made like 45% within like 4 months pretty much, which was an amazing return. But after I sold it at 1,400, the stock went pretty close to 2,800, and then it fell back to 1,300. So it's a pretty crazy company. But I do love looking at the 13Fs, which is why I'm gonna analyze Seth Klarman's stocks that he actually bought in his latest 13F. Most of you are familiar with this legendary investor. He's actually been doing a lot of interviews lately, which I've been listening to. They're pretty amazing. Seth Klarman did buy 4 new stocks in this 13F quarter: Amazon, Dollar General, Union Pacific, and CRH. Now, most of his stocks are actually up a lot since he bought them 3 months ago. But one of the stocks that's slightly closer to his cost basis is actually DG, which is Dollar General. Dollar General is very interesting in my opinion, and I'm very happy to see Seth Klarman actually jumping in, Dollar General. A lot of the kind of retail stocks, I've been talking about them on the channel. They've been facing a lot of problems. They've been underperforming. No one likes them anymore. I'm very happy to see Seth Klarman kind of agreeing with what I've been trying to say within the kind of retail stocks, that they've been hated and most people don't want them a lot. And if you look at where Dollar General is trading at, it's trading at March or April kind of levels, which is very, very low. Massive down move on guidance and a lot of other things, which makes it very interesting for us to look at here in this video. And if you look at just a basic forward PE ratio, you can see that, pretty much Dollar General went from around 24 times forward earnings, now sitting around 16 times forward earnings, which is much lower than the mean of around 18 times. So the stock has a lot of bad sentiment, is pretty much back pretty close to the mean, where it pretty much gets close to bottoming at, and then it normally bounces from there. So it's in a very, very interesting place for us to do an analysis on in this video. Now, if you actually look at the earnings report of Dollar General, it wasn't actually bad at all. They put up good comp sales, good sales growth, everything was not too bad actually. But the worst thing about the report is the guidance, and this is why the stock is down so much. And this is what Dollar General said. They said that net sales growth approximately between 3.5% to 5% versus 5.5% to 6%. Same-store sales growth 1 to 2% versus 3 to 3.5%. Now this is the worst one. Diluted EPS, approximately 8% decline to flat. So they have no idea where the EPS is going to be at. And this is what the market hates. The market hates uncertainty, which makes it harder for them to actually price in the stock. So this is a massive difference between 8% decline to flat versus their previous expectation, which was a growth of 4 to 5%. So they went from growing 6% to approximately declining 8%. So this is a massive difference in a lot of the things that changed with Dollar General, and is freaking out the market. And Seth Klarman really likes such scenarios. He likes bad sentiment, kind of like what I do in my videos. But one of the worst things also about the guidance, it says the company's guidance assumes no share repurchases in 2023 as compared with the previous expectations of approximately 500 million. They always give guidance on how many shares they're gonna buy, and normally they do go under guidance and they buy back a lot of stock. You could look at it here. The company buys around 3 to 4%, sometimes 5% of their market cap every single year. But now this is the time they should be buying stock, because the stock is sitting at record lows. Yet they're not going to be buying stock in this quarter. I'm going to go a little bit deeper on why they might actually not buy any stock at all in 2023 and potentially even in 2024, which really sucks for shareholders, because they're not going to be able to unlock shareholders' value when they should be really doing that. They were buying back stock around 260. Now the stock is at 160 and they cannot buy back stock. So this is the reasons why the stock is down so much, and in my opinion it's actually warranted. Now if we look at the kind of earnings report, one of the things that a lot of the retail stocks and retail companies have been facing is actually labor cost inflation. A lot of the labor cost has been rising, much higher wages, because we have a tight labor market and higher inflation in general. And this is something that a lot of those retailers are suffering from. You could look at the SG&A at a percentage of sales. In 2022, it was 22.7. Now it's 23.7. So it's rising rapidly, over 300 million pretty much from 2022 to to 2023, and it's likely getting worse because we still have a tight labor market. So this is one of the reasons why a lot of those retail stocks, have been coming down on labor kind of inflation. The second one, some of them have much higher inventories, and this is something that Dollar General also has. They have 7.3 billion of inventories compared to 6 billion just a year ago, and 3 months ago they had 6.7 billion. So this is a massive rise in inventories, but they also should be going down in my opinion, because a lot of the Dollar General stores and a lot of stores in the United States have been facing a lot of theft, which is pretty bad, and I hope it gets fixed very soon. But these are all the reasons why the retailers have been underperforming. It could be one because of the AI stocks. People are excited about AI. They say retail is dead because Amazon is taking over. It's also because of higher labor cost inflation, which is decreasing margins, and it's also because some merchandise inventory issues and also some theft. So it's not a good year at all for retailers, but this is where a value investor like Seth Klarman or someone like myself would like to jump in when things don't look so good, and this is when you could potentially find a lot of bargains. But if we look at why Dollar General cannot buy back any stock at these depressed prices, and this is mainly because of the free cash flow and their long-term debt. And if we look at the free cash flow, it went down a lot in 2023, 253 million. This is most likely due to a rise in inventories, but 2024 is expected to be around 1.4 billion, which is what I'm going to use for my number. Still much lower than 1.8, which was pretty much last year, but I'm going to use 1.4, which I personally believe is a very fair number. Now, if we look at the dividends that the company pays, the last dividend was pretty close to $500 million, and if we take a 1.4 billion of free cash flow, 500 million, so they would have around $900 million an extra every single year for them to buy back stock. But they cannot use it to buy back stock because they have near-term maturities on a lot of the debt. For example, in 2024, they have 750 million maturing in debt, and they have 900 million of free cash flow. So this is going to take most of the free cash flow. In 2025, they have 500 million of debt maturities. In 2026, they have 600 million, and now they cannot refinance it like they used to do before because they have low interest rate on those. They have 4%, 3.8%. If they're going to refinance it, it's going to be 7, 8%, maybe something a little bit higher, or maybe the best case scenario 6%, which is really going to hurt free cash flow. So now they have to pay back the debt, and because they have to pay back the debt, they're not going to have a lot of free cash flow left for them to buy back stock, which is very sad and very bad for shareholders. I mean, it sucks because this is when the company should be buying back stock. They should have been buying at the top, and now they're sitting pretty close to 2020 kind of levels, as the company cannot buy back stock because they were buying at the top instead of doing something with the debt or pushing it to a later date. Now I'm going to take a look at my valuation model to try to determine if Dollar General, is fair at such prices or not. I did talk about their guidance between 4 to 6% revenue growth, so I left it at 4%, and then I put in 6% between 2024 and 2027, assuming 2023 is the worst year for those retailers, which I believe it is, and 6% is still much lower than the historical average, so I believe this is a fair number. Net income margin, 6%, I kept it at 6%. PE ratio, I used 17 times earnings, although I could use something a little bit higher. But if you look at the historical average, it's actually closer to 18 times earnings. But if I use 17, which is not bad, now trading at 16, I still believe this is a very fair number. And if I use a 4.4% dividend, now the dividend is not 4.4, the dividend is something like 1.4. But I did talk about them buying stock back a lot before, around 2, 3, 4%. And now they're not going to be able to do that much anymore. So I put it around a 3% buyback and 1.4% for after 2023, which I believe is very fair, especially if we have lower rates in 2024 or 2025. They can maybe refinance a lot of the debt. Maybe this is an optimistic view, but using 17 times earnings instead of 18, 19, or 20, I believe this would make the entire assumption very fair. And in this case, I would get around 60% on the upside, or 9.8% compounded every single year for the next 5 years if I buy Dollar General at such prices. Now, if I want to double my money on something like Dollar General, I would have to buy it around $133 per share. At $133, I mean, it's somewhere close to what it was trading at in March 2020, and Seth Klarman just bought the stock. So I might be wrong on this assumption. I don't believe, maybe it's not going to go to $133. I don't really know. By using pretty fair numbers, I got $133. I mean, if I use 18 times earnings, which is like one of the best case scenario, that would be around 140 for me to double my money. So I would personally not touch Dollar General unless it gets closer to $140 per share. I think it would be a much safer bet. But this is just me. Seth Klarman bought the stock, so maybe he's saying something that I'm not saying. But this was my analysis on Dollar General. No financial advice, of course. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.